Your $10,000 stock investment might owe $1,200 in taxes you didn't expect, and it's not because of a dividend. Here's why: when companies like Berkshire Hathaway spend $50 billion buying back shares, it can trigger capital gains taxes in ways most investors ignore. The IRS has specific rules about when these transactions hit your tax bill, and understanding them could save you thousands. We break down taxes so they actually make sense, and today's topic affects everyone with a brokerage account. Let's start with the basics. When a company buys back its own stock, it's not just a win for shareholders. It's a tax event. Here's what most people miss: unlike dividends, which are taxed as ordinary income, buybacks can trigger capital gains taxes, but only if you sell your shares after the buyback. Wait, that doesn't sound right. Let me clarify. Actually, the IRS treats buybacks differently. When a company repurchases shares, it's effectively increasing the value of the remaining shares. If you hold onto those shares, you don't owe taxes immediately. But here's the catch: if the company distributes the shares back to shareholders, a rare move, or if you sell your shares after the buyback, the IRS considers the gain from the increased value as a capital gain. That's where the $1,200 figure comes in. If your $10,000 investment saw a 12% increase from a buyback, that's $1,200 in taxable gains. But here's the twist: the IRS's wash sale rules complicate things further. If you sell shares at a loss and repurchase them within 30 days, the loss is disallowed. However, buybacks aren't typically tied to individual sales, so this rule doesn't apply directly. Still, the timing of a buyback can influence when you realize gains. For example, if a company buys back shares in January and you sell in February, the gain is taxed in the year of the sale. This is where most investors go wrong. They assume buybacks are a tax-free event, but the reality is more nuanced. The IRS publication 550 explicitly states that capital gains are taxed when you sell the asset, regardless of whether the gain was created by a company's actions. So if a buyback inflates the value of your shares and you later sell them, you're on the hook for taxes on that gain. But here's where it gets even more interesting: the IRS doesn't just look at the total gain. It considers the holding period. If you've held the shares for more than a year, the gain is taxed at the lower long-term capital gains rate. If you sell within a year, it's taxed as ordinary income. That's a big difference: 22% versus 37% for high earners. So what does this mean for you? If you're holding shares in a company with a history of aggressive buybacks, you need to track when those buybacks happen and plan your sales accordingly. Ignoring this could mean paying higher taxes than necessary. Let's dive deeper into the IRS's rules. The key here is understanding when a buyback becomes a taxable event for you. The IRS doesn't tax the company's buyback directly, it taxes you when you realize the gain. That means the timing of your sale is critical. Take Berkshire Hathaway's $50 billion buyback plan as an example. If you own shares in Berkshire and the company buys back 10% of its stock, the value of your remaining shares increases. If you sell those shares after the buyback, you'll owe taxes on the gain. But if you hold onto them, you don't owe taxes until you sell. However, the IRS has a rule called the constructive sale doctrine. This applies when a company's buyback significantly reduces the number of shares outstanding, effectively increasing the value of the remaining shares. In such cases, the IRS may treat the increase in value as a taxable event even if you don't sell. This is rare but possible, especially in large buybacks. Another layer to consider is the wash sale rule. If you sell shares at a loss and repurchase them within 30 days, the loss is disallowed. But buybacks aren't typically tied to individual sales, so this rule doesn't apply directly. However, if you sell shares in a company that's about to announce a buyback and then repurchase them later, the wash sale rule could come into play. Here's a real-world example. Imagine you own 100 shares of a company trading at $50 per share. The company announces a buyback, and the share price jumps to $60. If you sell your shares now, you'll owe capital gains taxes on the $10 per share increase. But if you hold onto them, you don't owe taxes until you sell. The IRS doesn't care about the company's actions, it only cares about when you realize the gain. This is why timing is everything. If you're planning to sell shares in a company with a buyback, you need to consider the holding period. Selling after a buyback could push you into a higher tax bracket. For example, if you sell within a year, you'll pay ordinary income tax rates, which are higher than long-term capital gains rates. But here's the thing, most investors don't track these nuances. They assume buybacks are a tax-free event, but the reality is more complex. The IRS publication 550 clearly outlines that capital gains are taxed when you sell the asset, regardless of whether the gain was created by a company's actions. So if a buyback inflates the value of your shares and you later sell them, you're on the hook for taxes on that gain. Now that we've covered the problem, let's look at solutions. Here are 3 strategies to minimize the tax impact of buybacks. 1. Time your sales strategically. The most straightforward way to reduce your tax bill is to sell shares after holding them for more than a year. This qualifies the gain as a long-term capital gain, which is taxed at a lower rate, typically 15 to 20% for high earners. If you sell within a year, the gain is taxed as ordinary income, up to 37% for 2026. So if you know a company is planning a buyback, wait until after the event to sell. 2. Use tax-advantaged accounts. If you hold shares in a retirement account like a Roth IRA or 401k, any gains from buybacks are tax-free. This is a game changer. By holding buyback-eligible stocks in these accounts, you can avoid capital gains taxes altogether. For example, if you hold $10,000 in a Roth IRA and the buyback increases its value by 12%, you don't owe taxes on the $1,200 gain. 3. Tax loss harvesting. If you've lost money on other investments, you can offset buyback gains by selling those losing positions. For example, if you own a stock that's down 10% and another that's up 12% due to a buyback, sell the losing stock to offset the gain. This reduces your overall tax liability. However, be cautious of the wash sale rule. If you repurchase the losing stock within 30 days, the loss is disallowed. Now, you might be thinking, but I don't have a tax-advantaged account. That's a common concern. If you're a W-2 worker, consider contributing to your employer's 401k or opening a Roth IRA. Even a small contribution can make a difference. For example, if you contribute $6,000 to a Roth IRA and the buyback increases the value of your shares by 12%, you'll save $1,200 in taxes. Another objection: I don't know when companies will announce buybacks. That's where tools like Yahoo Finance or Bloomberg come in. They track buyback announcements and can help you time your sales. If you're not comfortable with that, consult a tax professional. They can help you navigate the complexities. Finally, remember that the IRS is clear on this: capital gains are taxed when you sell, not when the gain is created. So if you hold onto your shares, you can avoid taxes until you're ready to sell. That's a powerful tool and one most investors overlook. If you're rethinking how to handle stock buybacks, hit subscribe. We break down tax strategies every day. Remember, understanding how buybacks affect your taxes can save you thousands. Check back tomorrow for how to optimize your 401k contributions.